Welcome to CGD's conference call. This call follows the first 9 months 2024 consolidated results release, which took place yesterday. It is possible to follow the results presentation from the CGD website. The CFO, Ms. Paula Giada, and the head of IR, Mr. Nuno Pereira, will guide you through the presentation, and a Q&A session will follow.
Hello, good morning, and welcome to CGD's 9 months results presentation. Our results presentation is available on the website, and it will be hosted by our CFO, Mrs. Paula Giada, to whom I will hand you over now. Thank you.
Hello, good morning, and thanks for assisting the call. I think we can start with page 6. CGD is recognized by its customer and has been seen from its leading positions in different products and different services like deposits, investments, and credit. So CGD maintains leadership in core sectors in a very competitive market. In the next slide, page 7, DBRS upgrades its long-term senior issue rating to A low, while maintaining a positive trend. I think it's important to say that according to DBRS, the upgrade of CGD's long-term rating reflects a significant improvement in profitability and the reductions of the NPL exceeding that of its domestic and international peers. These two factors, according to the DBRS, demonstrate the effectiveness of CGD restructuring and the risking of its balance sheet. In addition, the rating upgrade reflects also a strong capitalization, supported by higher capacity to generate organic capital. I think it's important to say that the positive trend reflects also an upgrade in the next month, because CGD maintains a positive outlook with two agencies, the Fitch and the DBRS. On the next slide, skipping to the page 8. Digital continues to occupy a central position in the Caixa strategy. We can see in these figures an increase in the number of active digital clients, active mobile clients, and online sales. Digital business is growing strongly, and CGD is market leader in Portugal with more than 2.3 million digital customers, of which 1.9 million were mobile customers. I want to highlight the number of financial transactions on digital, which up 57% in the last 7 years and 8% year on year. We can say with convictions that our customer experience will grow with the new digital offering. Moving to page 9, CGD actively contributes to sustainable development, and this is another key pillar of our strategy. CGD Group's first Sustainability Week took place on September. Under the CGD Group employees participate in various training activities, sharing of good practice and networking activities, contributing to greater corporate alignment of knowledge and approach to ESG issues. CGD has been promoting the incorporation of ESG factors also on other banks that we have in other geographies. On the next 2 pages, page 10 and 11, And in terms of awards, CGD was distinguished by several entities in different categories, such as human resource, ESG, brand, digital, capital, investment banking, and asset management. I want to highlight that CGD is the most valuable banking brand in Portugal. So, and go to the numbers and moving to the results and balance sheet. We can see the breakdown of the net income. CGD achieved a net income of 1,369 million euros in the 9 months of this year, a 38% growth compared to the same period of last year. The net profit benefiting from the growth in business volume, the positive evolutions of the net interest income, and the lower cost of risk sustained in a more favorable macroeconomic scenarios. Domestic activity contributes with 1.2 billion euros to the consolidated results, and the international activity with 150 million euros. So moving to the page 14, we would like to remind you that the results accumulated after the recapitalization only in 2023 made it possible to offset the losses accumulated between the 2011 and 2016. The average return on equity since 2011 reached 1.2, while in the period after the recapitalization rise to 9.1%. So, even with this sustainable growth in the bank's result, the return on equity since 2011 was below the cost of capital. And return to the evolutions of net interest income that increased 1.9 year-on-year in Portugal. And despite the recent reductions in interest rates, the net interest income was up, supported by the retail business, with increase in volumes of loans and deposits, and the contributions of treasury activity. On the retail side, we felt the impact of the higher cost of deposits, while loan repricing started to reflect lower Euribor rates in 2024, and the spread effect also had a negative impact on net interest income. The net interest margin on 9 months was 2.53%. Going to the next page, 16, and about the commissions. Commissions increased 2.6 in the consolidated and 0.9 in domestic compared to the same period of 2023. As you can see in the right-hand graphic, credit, contas Caixa, and other commissions decreased 8 million euros. And we had the payments, funds, and insurance increased 11 million euros. This evolution is mainly justified by the application, and I can say that the credit and contas Caixa and others with the decrease, and this evolution is mainly justified by the applications of exceptions and by keeping the price unchanged. And about payments, funds, and insurance, we can say that is justified by the increase in volumes of commissions received from means of payments and banking service associated with the increase of business volume in the 2024. On page 17, the recurrent operating cost increased 16 million euros, which represents an increase of 2.3% year-on-year on consolidated. In Portugal, we had also an increase of 2%. there was an increase in employee cost up 2.1%, and a decrease in general administrative expense down 3.5%. The increase in employee cost reflects an average adjustment of 3.25% in wage in Portugal. Including non-recurrent effects, the operating cost down 1.4% compared to the same period of last year, justified by the decrease in employee costs due to the extraordinary effect related to the employee restructuring program. Overall, the costs are growing, but at a very controlled level. On the page 18, and as a result of the evolutions of core income and the effort to contain costs, CGD maintained the level of efficiency on 28.6%. The recurrent cost to income is lowest on the national banking and the European sector. Going to page 19, the increase in income results in an increase in taxes with a strong impact in 9 months of this year. And we can see when we compare with the value paid in 2023. On page 20, the international activity contributes to 150 million euros. The international activity has a negative impact by exchange rate variations, particularly in the activity in Angola. Among the international entities, BNU Macau and BCI in Mozambique were the ones that made a strong contribution to the result. Moving on to page 21, CGD's consolidated net assets reached 104 billion at the end of September 2024, an increase of 5.9% compared to the same period of last year. During these 9 months, there was a very positive evolution of business volume. CGD recorded a business volume of 162 billion euros on consolidated and 144 billion euros on Portugal, an increase of 3.9% and 4.4% respectively. On the next page, 22, the customer resource increased with competitive deposit remuneration. Caixa offered a very competitive range of deposits to meet clients' needs and objectives. So, in the 9 months, customer resource grew by 4.8% due to the growth in deposits. The off-balance sheet also increased, and mutual funds and financial insurance maintained the leadership position, as you can see in the right hand graph. Moving to page 23, Caixa continues to be a trust brand for the Portuguese and maintained its leading positions in total customer deposits with a 23.1% market share. In the individual customer deposits, Caixa records a market share of 31.5% and have the leader positions too. In domestic market, the customer deposits increased 7.4% year on year and 5.6% year to date. And I think it's important to say that this increase is above the market evolution. Skipping to page 24, in Portugal, the loans and advance to customer grew 2.9%. This growth was higher than the market and reflecting a competitive and diversified offer based on a strong commercial dynamic. CGD is the market leader with a market share of 17.7%. And it's important to say that the growth of credit in SME, one of the strategic pillars of support of the economy. On the next page, we can see the corporate and public sector loan portfolio grow 3.6% year to date and 3% year on year with a market share of 17%. Higher growth than the market is consistent with our strategy of economic support, as I said before. Skipping to page 26, when we look at the stock of the mortgage loans in Portugal, there is an increase of 2% in this year and 2.5% compared to the same period of last year. CGD maintains the leadership with 23.3% of the market share. This performance is very positive given the current highly competitive market scenario. On the next page, the new mortgage loans present an increase of 46% more compared to the same period of the previous year. This growth is higher than the market, which proves the competitiveness of our offer and our service. We continue to promote our 2, 3, and 5-year fixed rate offer. The rate of fixed mixed rate loans increased to 91% of new loans, and early repayments to at 9.2% are below market level that was 11.1%. Skipping to page 28, CGD maintains prudent lending granting criteria, reinforcing the ability to absorb potential adverse shocks in the future. The LTV in the last year decreased in the portfolio at 15 and 10 basis points on new contracts and 50 basis points on the portfolio and 10 basis points on the new contracts. CGD has a high-quality mortgage book with only 10% loans having a LTV above 80%. Moving on to page 29, the consumer credit maintaining the growth trajectory with a growth of 7.9% year on year, and the new loans market share is 6.3%, and CGD want to reach higher. And moving to page 30, and then in terms of asset quality, the volume of non-performing loans in the 9 months decreased 35 million euros, and NPLs net of specific impairments remains below the national and European average. Moving to page 31, the NPL ratio reached 1.59% compared to 1.65% in December 2023, the lowest value in national banks and below the European average. In September 2024, the total coverage is 185%, and the NPL net of impairment remains at 0. Skipping to page 32, the improvement in the macroeconomic environment above expectations had an impact on provisions and impairments for credit risk. But I think it's important to say that despite this evolution, we maintain a conservative approach on management credit risk. This change is mainly related to the CGD activity in Portugal, and as a result, the cost of credit risk decreased to minus 0.47% in September 2024 from 0.29% in September 2023. On page 33, and when we look at the breakdown and the evolution of by stage of our credit, but consolidated and domestic, it is pretty stable. Stage 3 remains at very low levels and decreased in this period as a result of non-performing credit sales and cures, resulting of the better than expected improvement in Portuguese macroeconomic environment. There was migration from stage 2 to stage 1. So there was a decrease on stage 2 as a result of the improvement of the risk profile of the client and the resulting of the amounts in debt. Stage 1 loans represent 89.5% of the loans portfolio. In the evolutions of stage 1 reflect a better quality portfolio growing. Going to the next page, 34, the non-core assets continues to decline, exposed to non-core assets and non-performing loans, real estate and restructuring funds down 114 million this year. The real estate available for sale decreased, but in terms of properties of the extinction pension funds, as the remain assets by a total of 48 million euros, and corporate restructuring also decreased. Skipping to page 35, the size of security portfolio increased in 2024 as deposits increased and yields became more attractive. It represents around 50% of assets in line with the recent past. The risk profile has remained unchanged with the concentrations on Eurozone sovereign, although the attractive level of credit has led to further investment in this segment. On the next page, page 36, and regarding to CGD Group funding structure, customer deposits assume a fundamental weight representing 91.1% of total consolidated liabilities, and the loan to deposit ratio in September of this year stood at 61.5%. About liquidity positions on page 37, CGD liquidity position remains strong and grounded on retail deposits and with central bank deposits at 22 billion euros and the liquidity ratio stable well above regulatory requirement. About the MREL on page 38, the MREL ratio as of September 2024 was 27.88% of total risk-weight assets, exceeding the target level determined by the resolution authorities for mandatory compliance with the applicable minimum prudential requirement, 26.33%. On page 39, capital ratio reached by the FAR regulatory requirement to CET1 and total capital ratio. It's important to highlight that the capital reached in CET1 21 and total 21.3% after the distributions of the dividend of 825 million euros in this year. On the next page, page 40, CGD CGD had a solid result and improved its profitability in a consistent manner, allowed for the payment of dividends, and as I said, in the amount of 825 million this year. With this payment, CGD fully reimbursed with the dividends paid since 2019, the cash injections of the 2017 public recapitalization in amount of 2.5 billion, after having already reimbursed the private sector components of 1 billion in 2023. Skipping to the page 41, we want to highlight the increase in results enabled CGD to achieve 10.1 billion euros in equity capital and to generate since 2017 organic capital of 5.7 billion euros, exceeding the recapitalization plan 3.9 billion euros. CGD paid a total amount of 2.5 billion euros and retained capital of 3.1 billion, and capital generated since 2017 exceeds by 1.4 times the public investment of the recapitalization plan. And finally, on page 42, I would like to conclude this conference call with a set of figures that show how Caixa has performed over the last 9 months. A solid performance that we want to maintain in the future in terms of profitability, asset quality, efficiency, the strong positions on capital. We maintain commitment to remunerating our stakeholders appropriately while maintaining adequate risk management, always the aim of serving our clients better and supporting the economy. Thank you.
Okay, thank you and we will be glad to take your questions at this moment.
At this time, we will open the question and answer session. If you would like to ask a question, please press star and 1 on your telephone keypad, and you'll be placed into the queue in the order received. You may remove yourself from the queue at any time by pressing pound and 1. Once again, to ask a question, press star and 1 on your phone now. Once again, to ask a question, please press star and 1 on your phone now. It appears we have no questions at this time. I'll now turn the program back to our presenters for closing remarks.
Once again, thank you for listening in today on our conference call. It was a pleasure to deliver to you the 9 months results. And as always, the Investor Relations team will be available for any further questions that you may have in the next few months. Thank you, and have a nice day.
Thank you for attending the conference call. The audio webcast will be available on the CGD website.